Hello, and thank you for joining us for today's webinar. My name is Jessie Lambert, and I'll be your host for today's event. Before we get started, we have just a few quick housekeeping announcements. First, you will be receiving a recorded version of this webinar via email, so be on the lookout for that. Second, if you have questions for our presenters today, please enter those in the chat box located on your screen. Now, I would like to introduce our presenters. Today, we have John McFarland and Ben Conley on the line. John McFarland is the president of Cleartrack HR. He has 20+ years of experience in the employee benefit and HR tech industry. He has served in both sales and management capacities for multiple companies, where he has consulted on individual benefits, employee benefit packages, benefits administration platforms, and enrollment technology tools. His current responsibilities include overseeing the strategic planning of Cleartrack HR, managing the internal sales activities of the company, as well as developing national partnerships. John, thank you for being with us today.
Thank you so much, Jessie.
We also have Ben Conley on the line. Ben counsels clients on qualified retirement plans, health and welfare plans, and executive compensation. He regularly advises clients on defined benefit and defined contribution plan compliance, including corrections for plan operational errors. Ben, thank you for being with us today.
Thanks for having me.
John and Ben will be tackling a lot during today's webinar. You'll be learning more about the importance of maintaining benefit compliance and specifically how it can increase your bottom line. They'll also be sharing benefit compliance updates and speak to how dependent eligibility verification can help with rising benefit costs. Now, it is my pleasure to turn this event over to our presenters, starting with Ben. Take it away.
Thank you very much. And we're going to hit on a couple different things today, as Jessie noted, but one of the first points we're going to cover is sort of the building blocks on why employers might be considering dependent eligibility audits. And it's really twofold. One is a business reason and one is a legal reason. So we're going to start with the business reason and get into the other considerations in a moment. As you can see from the statistic up on the screen right now, and this is no surprise to most people, health plan costs are projected to go up next year. And again, that's not surprising, hopefully, because health plan costs have been rising year over year, certainly on a longer term trend or arc, but most years without exception, these amounts are going up. And in fact, this 5.3% is actually lower than what we see in many years, which likely has something to do with the pandemic and some of the changes in the workforce and things like that deriving from the pandemic. But it's pretty common to see, 10% year over year increases in health plan costs. And if we go to the next slide, what you'll see is that that this amount can vary based on the size of the employer. But another important point on this slide is that there are, avenues that employers can and do pursue to minimize or offset these changes or these costs. And I mean, there are really only a couple levers you can pull because a lot of this is outside of your control, right? A lot of this is driven by medical inflation. So even if your population doesn't change, your benefit design doesn't change, your health plan's costs are going to go up year over year just due to medical inflation alone. Which is starting to become a real pain point for employers. It's gotten to a point, especially when you factor in things like prescription drug costs, where healthcare costs, which were usually sort of an HR function, are starting to become a C-suite type consideration, given the overall value of these costs as compared to any given organization's bottom line. And the levers you can really pull are shift the cost to employers, change the design, which, is usually cutting benefits, increasing deductibles. That probably falls somewhere in between changing the design and shifting the cost to employees. Or then the final one is sort of to explore creative solutions in the category of what we would typically call, when you hear the government talk about these things in the Medicare context, fraud, waste, and abuse, right? So these are provider overpayments, ineligible dependents participating in the plan, which probably falls under the category of somewhere in between sort of inadvertent error or potentially fraud, or unnecessary services, right? You see a lot of organizations considering things like optional or even mandatory second opinion services because it's proven that offering second opinion services can drive down your cost because it could reduce or eliminate redundant or unnecessary medical procedures. But at the end of the day, if employers want to rein in costs, those are really the only available levers, because you can't just say, well, let's press pause and everything will remain the same. Ultimately, costs will go up. And if we go to the next slide, you can see what this means. And the I think unfortunate thing or disappointing thing about this is that, notwithstanding some of the changes in the last couple of years, employees still don't necessarily understand the full value or cost of healthcare. That doesn't mean that employees won't necessarily complain if you increase their premium, but I think that what a lot of employees don't realize is that what they're seeing is really just the tip of the iceberg in terms of the overall cost of that health insurance. And we saw, a couple avenues attempting to illuminate or shed light on this in the wake of the Affordable Care Act. One, which kept getting delayed and was finally killed off a couple of years ago, was the Cadillac tax, which was intended to impose an excise tax on high value, high cost health plans, with the intent of reining in designs to sort of limit the actuarial value of that health insurance. Another was the Affordable Care Act requires that employers include on the Form W-2 the full cost of health insurance coverage. That's not the amount the employee pays, but it's the COBRA rate. Partially to help with Cadillac tax, but also the idea here was that this employees should understand the full cost of the value of this benefit that their employer is providing them, when they often don't. And as you can see on this slide, it varies by employer population, but we see employers cover anywhere from 50 to, in some instances, 90, 95% of the cost of health insurance, but 70% is probably a good average there, which means that when health insurance costs go up by 5%, that increase in cost is disproportionately borne by the employer in that circumstance at the end of the day. So if we can go to the next slide, we can talk about some of the concerns amongst employers relating to health insurance benefits. Now, these are probably disproportionately driven by the pandemic. So, increase in virtual services, that's obviously been a big issue this year because employees are clamoring for ways to avoid actually going to the physical doctor's office due to the pandemic. And then the mental health one too, right? We are seeing a spike in mental health service claims because of people's isolation and fear and anxiety and so on and so forth. So those top two, not saying that you wouldn't see those on the chart from year to year, but they've probably been artificially bumped up this year. Now that said, if you look at specifically item 3, focusing strategy on moderating high cost claims, that's usually the big one. And the big trigger point that we're seeing for employers this year, and frankly for the last couple of years, relates to pharmacy benefit drugs or specialty medications. Depending on the size of your workforce, but to a certain extent, regardless of the size of your workforce, employers are just getting killed right now by prescription drug costs, and specifically specialty drug costs. And it's both from a broad sort of increase in medical trend perspective, but also, the nature of specialty drugs are such that it takes no more than one person in your population who has a rare condition that can cause the need for a specialty drug. And some of these specialty drugs, they run $2 to $3 million annually, right? You're talking about $200,000 a month for the cost of some of these drugs, depending on the specific condition that the individual might face, which, is challenging for any population, right? Like, even for a large employer, that's a difficult cost to absorb. Smaller employers typically have some form of reinsurance, but even with reinsurance, stop loss reinsurance carriers have the right to and the ability to laser high cost claimants. So while that might cover you in year one, if you have an ongoing issue with a member of your workforce who has a high cost condition, Year two, that becomes your cost as the employer with no coverage from a reinsurance perspective. So, it's a problem, right? These costs, and specifically, not just routine increases in medical costs, but these high cost drugs are disproportionately increasing the cost of offering benefits to employers. I was on a call with an organization this morning that counsels employers on prescription drug costs, and the whole call was focused on specialty drugs and, considering the nuclear option, which is excluding specialty drugs entirely within the health plan, given how much that is starting to cost employers. And then if we can go to the next slide, employers always sharpen their pencils more as economic times look more dire. I sit on the benefits committee for my organization, and I can tell you how our renewal process went this year. Our brokers came in and proudly told us that they held down our health benefit cost increases to 11%, which was, as you saw, higher than the trend, right? National trend. And we countered and said, look, our management has told us we need to go 5% down from last year, right? Rather than weather an 11% increase. So we need to find some savings. And I've been on this committee for a while, so I can tell you that, we never like increases in our health benefit costs, but most years we would tolerate an 11% increase. But given the recession, we, like everyone, are looking to save dollars through whatever avenue possible. And so, our management is directing us to do the impossible, essentially, which is, we don't want to cut benefits, but we don't want to spend this much money on health insurance. So that requires that we and many other employers as well try to get creative in how they handle this. Now, this year's been a sort of an interesting year from a health plan cost perspective. If we go to the next slide, it's created a real anomaly, and we work with a lot of organizations and hospitals systems as well. And so I think it's no surprise to anybody that health plans actually ran at a pretty good clip for the first part of this year. You've had this conundrum or this dichotomy, I guess, where there was for a while a drop off in all elective services, right? Because if I need to go get a shoulder replacement, I'm a lot less likely to do that during a raging pandemic than I am during any other random year. So for a couple months there, and even still, a lot of elective procedures are being deferred. Now that said, what we are seeing on the converse side is that, while for the most part this isn't by and large sort of the outcome if somebody gets coronavirus, but there is a sliver of that population that can become a very expensive condition, requiring that individual to be in the hospital for extended stretches of time, essentially hooked up to a ventilator. Some of the drug treatments that are emerging in connection with coronavirus are somewhat expensive. What we're seeing is that for employers that are starting to get broad-based testing regimes in place, because we all know testing is being pushed, as often and early as possible as a preventive measure to spread coronavirus. That's starting to become a more material cost for employers. So that's, where things are going to shake out at year end. If you're looking at a calendar year plan, I think is anybody's guess at the end of the day. I would still think it's probably going to be a little bit down, but it's really population specific, right? At the end of the day, one or two cases of COVID within your workforce can really spike the cost. And then sort of what's been going on in your area, geographically speaking, can also drive things, because the areas not as hard hit are a lot less likely to have, elective procedures shut down in their hospitals and as a result drive down costs in that regard. So it's a challenge, but we're going to see, I think, a range in terms of cost increases or decreases this year. If we can go to the next slide. So that's the overview of sort of the business side of the house, right? Before we move on to talk specifically about dependent eligibility audits, we do want to talk a little bit about legal updates. So if we can go on to the next slide. So there's been a series of guidance issued over the course of this year that predominantly stems from coronavirus and COVID-19, one of which was a proclamation from the federal agencies governing employee benefits plans that essentially said, hey, given the pandemic, we're going to be we're going to limit your ability as a plan sponsor to regulate plan deadlines. So what does that mean? What the government did was it took March 1st as the start date of what they have labeled as the outbreak period, which is tied to the coronavirus national emergency. And what they effectively said is starting on March 1st and running through the emergency declaration period, which is, end date TBD right now because it keeps getting extended and seemingly is going to be extended for a while now, given that yesterday was our highest case count nationally ever. That emergency period, that outbreak period, will continue through the end of the emergency period and then an additional 60 days. So that's what's known as the outbreak period. What the government said was that during that outbreak period, the plan is prohibited from enforcing certain deadlines. So these would include things such as claim, appeal, or external review deadlines for any ERISA benefit plan. To the extent a deadline arises on or after March 1st or during that period, usually those claims have deadlines to file them, and that deadline is tolled during the emergency period. Another deadline that's tolled is the HIPAA special enrollment deadline, so folks on the phone know that following a birth, marriage, adoption, loss of other coverage, HIPAA rules create the right to enroll in a health plan as long as notice is provided within 30 or 31 days following the event, 60 days in certain circumstances. What the government has said is, given the pandemic, we want to make sure that access is available, notwithstanding what's going on in life. So people who have experienced the HIPAA special enrollment event anytime after March 1st can come to the plan at any point up through the end of the outbreak period and request enrollment in that coverage. The final one, and perhaps the most important one, relates to the COBRA election and payment period. So what the government has said is that if you have a qualifying event under COBRA and would lose coverage or have lost coverage and would typically have a 60-day deadline to elect COBRA coverage if you intend to enroll in COBRA continuation coverage, that deadline is also tolled, meaning you can potentially go months into your termination and elect coverage retroactive to the date of your qualifying event. Moreover, the government said you cannot terminate someone or their coverage or their COBRA right due to non-payment of coverage premium during the emergency or outbreak period, meaning that individuals have a much longer window to make up late or missed COBRA payments during that window. So that's an important piece of government guidance that employer plan sponsors are struggling to deal with because it's essentially stopped the clock on various deadlines. We go to the next slide, just sort of a housekeeping item. Annually, the government adjusts various limits that we've got reflected on the screen here. Out-of-pocket limits have increased. High deductible health plan thresholds have also increased. That happens annually, and we've got on the screen the new limits for 2021. Next slide, just a couple more pieces we want to cover here. The IRS issued guidance that was permissive in nature that modified the Section 125 cafeteria plan rules. So folks on the phone know that generally speaking, if benefits are paid for on a pre-tax basis, health FSA, medical premiums, whatever the case might be, Section 125 rules typically require that those elections be made before the start of the calendar year and can only be changed during the calendar year if A, the person experiences a qualifying life event, and B, that person notifies the plan within the required time frame, usually 30 or 31 days. What the IRS has said is that in light of the pandemic, employers can choose to open up that Section 125 plan for changes. Now, employers can put guardrails on that. So we haven't seen employers broad-based say, yeah, anytime you want to make a change for any reason, come tell us. We're seeing some employers open, say, like a 2-week mid-year enrollment window for employees to make election changes. these are all permissive. It's employer's discretion as to whether they want to facilitate or allow this. The other thing the IRS said this extends to is making election changes with respect to your health FSA or dependent care FSA. And this, I think, is more directly tied to the pandemic. We had a lot of people saying, hey, I've got too much money in my dependent care FSA because daycare shut down, or I don't have enough because I had to hire special help because I'm working from home now, or school shut down, or whatever the case might be. As a result, the IRS said, hey, you can adjust those amounts. Same thing with health FSA. You're kind of making sort of the benefit of the bargain there at the beginning of the year. I think I'm going to have $2,000 in out-of-pocket medical costs. But that may have assumed, for instance, that your kid was going to go get braces, or you were going to have an elective surgery, which may no longer have been available given the pandemic. So the IRS essentially recognized that, all bets are off this year given the pandemic, and they have offered employers the ability, if desired, to open the door to mid-year election changes regardless of qualifying events for those amounts. The other big one in this IRS guidance, folks who offer health FSAs know that a couple of years ago, the IRS modified its use it or lose it rule with respect to health FSAs to permit employees to carry over up to $500 of unused monies within their health FSA to be used for expenses in the next year. That was a fixed $500 amount, but what the IRS has said in this guidance is that they are going to start adjusting that threshold for inflation. So starting for carryovers going into 2021, employees can now carry over up to $550, meaning employees may be more inclined to defer money into their FSA because they're less subject to forfeiture if unexpected events arise or they may not use those amounts. Simultaneously, Congress was busy passing various forms of coronavirus relief. And one of the acts they passed Families First Act and the CARES Act. Starting with the impact on health FSAs, the CARES Act would permit health FSAs to now reimburse for over-the-counter drugs. That always used to be the case before the Affordable Care Act. When the Affordable Care Act came along, it prohibited reimbursement for over-the-counter drugs. The CARES Act went back in and permitted reimbursement of over-the-counter drugs and menstrual products for that matter. So minimize the risk even more of deferring to a health FSA because, over-the-counter drugs are always available and pretty easy to spend money on. The final thing that the CARES Act did, and this was a big one, was it mandated that plans cover coronavirus testing at no cost. Excuse me. Mandated that plans cover coronavirus testing at no cost to employees. Obviously back to that whole government initiative to try and get people to get tested so that, it could limit the spread based on people knowing whether they have coronavirus. Eventually, when a vaccine is available, another component of the CARES Act will also mandate that plans cover that vaccine at no cost to the participant. But as we know, there is no vaccine at present. All right, so I am going to, I believe, pass it back to, I've got a couple more here. If we can go to the next slide. We want to switch back to the topic of dependent eligibility, changing gears here from this dependent eligibility piece, and talk a little bit about how dependent eligibility plays a part in benefit plan compliance. So if we go to the next slide, aside from just the cost savings associated with dependent eligibility audits, which we'll talk about in a bit here, there is an important compliance component to dependent eligibility audits. That compliance component specifically is that if you are the sponsor of an ERISA group health plan, you are subject to ERISA's fiduciary principles. One of ERISA's fiduciary principles is that you are required to maintain the plan in accordance with its terms for the benefit of the exclusive benefit of participants and their beneficiaries. So what does that mean? Number one is if your plan has eligibility rules, which plans are required to have under ERISA, you should adhere to those eligibility rules and only extend coverage to people who meet those eligibility rules. Number two is, as you have dollars flowing into to pay for benefits to that plan, i.e. participant premiums, those dollars should only be used for valid plan participants and their beneficiaries. So one of the big drivers of dependent eligibility audits here is just due diligence from an ERISA fiduciary standpoint, meaning it allows plan sponsors to demonstrate that they are attempting to discharge their fiduciary obligations by ensuring the plan is only covering eligible individuals. The second piece, and this is sort of pseudo-legal but also pseudo-financial, is that usually plans have some sort of insurance associated with them. That's either direct insurance for fully insured plans, or most employers, even very large employers, have some form of reinsurance or stop loss insurance to cover high cost claims. And what we know is from looking at a number of these different contracts, those policies only extend to people who are eligible under the terms of the plan as conveyed to the carrier. So the risk to the company is if you have allowed coverage for, because you as the employer are usually the gatekeeper as to who gets into your plan, if you have allowed your plan to cover an individual who is not otherwise eligible under the terms of the plan, that carrier can find that you are in breach of contract and either deny coverage for that claim specifically, or if it's an egregious error, cancel the policy entirely, and then you're sort of left holding the bag on the full cost of your health benefit coverage. So from a compliance perspective, we do think it's quite important to, and there's some flexibility here in terms of how you do it, but to have some system in place to ensure that your plan is only covering those people who are eligible and are intended to be covered under your plan. So I know I had a false start earlier, but with that, I am going to hand it over to John now to talk about the other side of the house in terms of what dependent eligibility audit is and potential cost savings associated with it.
Thank you, sir. I appreciate that. Appreciate everybody taking time today to be with us. And Ben has done a great job of kind of laying a foundation why there's obviously potentially a financial reason to do dependent audits, but also from the ERISA compliance piece, understanding why there's value in staying compliant with the benefit plan, keeping things legal. Oftentimes the question comes up, what is a dependent verification? People will ask questions about, I keep track of who's a student, I keep track of who's married, but a lot of times the verification piece is overlooked, meaning you don't have verification that that person that is put into the system is actually eligible from a legal standpoint. So the dependent verification allows the employer to make sure through tracking documents, keeping up with who should or should not be on the plan, like birth certificates or marriage certificates or any type of document that you would require to confirm that an employee's dependents are eligible to be there. Like Ben talked about, the cost is significant, so there is true value in making sure that you do have the right people on the plan. And going back to what it is, it's not just verifying that they are able to be on the plan from a employee dependent standpoint, but that they're legally able to be on the plan by showing documentation. A lot of times people don't even realize that if they are putting a dependent on the plan that's not eligible to be on the plan, that they're doing it illegally. We always use the term that we're keeping honest people honest. You need people to understand what the processes are. And for a lot of employers, that's very easy to do. When you get into employment situations where the onboarding process doesn't always go through an HR manager, there's a lot of times where people unknowingly will put a friend of the family or a grandchild. The grandchild might live with them, but they're legally not able to be there. Boyfriends, girlfriends, we've had all kinds of scenarios pop up. But it's very important to make sure that when you are offering that coverage to the person, that you communicate effectively to them what the plan rules are. Sometimes when you don't have that opportunity to communicate the plan rules effectively with that person, sometimes people slip onto the plan. So the dependent audit will help to make sure that they are that you're going through the right motions and having the right people on from a legal compliance standpoint as well from a financial standpoint. So the question a lot of times come up, why should I even conduct it? Ben talked about the financial savings, and we can talk a little bit about that here. These are national stats. 4 to 8% of covered dependents are ineligible for benefits. I know that seems like a lot. Depending on, if you think about it, if it's a richer benefit plan, a lot of times people, what our audits tend to find is that those numbers increase when you have a richer benefit plan. Obviously, it makes sense. You know, people are wanting to be on better benefit plans. And on average, an employer pays $3,000 per dependent annually. That's a big number. So if you start thinking about how many dependents you have on your plan, and you start thinking about 4 to 8% of those people, dependents, are not supposed to be on your plan, we've got calculators that we can provide you that show you real quick how that number adds up. And you know, that's one of those things where there's a couple different ways to look at it. Ben was talking about in his organization, they were saying, hey, you need to decrease by 5%, and the brokers were talking about an increase of 10%. That's a big swing. So it could be multiple things that could come to the table here. It could just be money that goes directly to your bottom line. It's truly savings that you're going to experience throughout the course of a year by having only eligible dependents on the plan. It could help with that increase, like Ben was talking about. If you're getting an increase and you actually are reducing that cost, it could help offset an increase that you potentially are having. Or it could help, you could increase your benefits, and you maybe have an increase, but you could actually increase your benefits, because in many times employers are looking for ways to stay competitive when hiring and retaining good employees. And so the benefit package is such a big part of it. And by making sure that you're keeping your costs low by having the right people on the plan, ultimately could give you options for allowing the benefits package to be more attractive to employers. So how can dependent eligibility compliance help? You know, it can be challenging when you're working with an employee base and making sure that you get the right message across to them, because you just don't want to go in and do an audit and kick people off the plan. There can be a negative connotation there. So when you start having the conversations about a dependent audit, we truly believe that communication is key to the success, and to have the correct mindset from your employees of what they're about to go through. So the process is all about education first, making sure that they understand the compliance piece of it, understanding that there's a legal responsibility that you have as an employer to keep that plan compliant, but also communicating the fact that there's people on the plan that aren't supposed to be. And so what we have found is that we do a lot of surveys and studies. If you educate your employees on the front end about what is going to take place, it gives them the opportunity to understand, one, why you're doing it. It's not just an employer trying to put money to the bottom line. And I think Ben mentioned it earlier, so many people don't understand insurance and how it works. And this is a great time to help them understand that, communicate the value of the benefits and why the costs keep going up, because you have good benefits, people use those benefits, and guess what? The more you use them, it can get a little bit more expensive. Obviously driving the need to have the audit to make sure that the right people are in place. But when people understand the plans and the benefits of maintaining the correct eligibility rules for ERISA reasons and for financial reasons, it makes it a lot easier for an employee to swallow that, because they know that the vast majority are doing the right thing, and what we have found is that people want people to be held accountable if they have people in the wrong. And that doesn't mean punishing someone. It just means making sure that we're keeping the right people on the benefit plan. So again, the key takeaway here is the communication piece of it, whether it's automated communications through email and text campaigns, whether it's communicating through live call center people, helping them to understand and walk through the system. But ultimately, communication is such a key part of it. Going back to talking about dependent eligibility, compliance helps the employees too. Again, this is not just something that benefits an employer. Obviously, the financial piece, there is a financial savings, but the employees are the ones that have the benefit plans that they're using. And so when you're cutting the cost, when you're not having to alter the current benefit plan to reduce the cost because you have the right people on the plan, that makes a big difference. And so the employee is actually benefiting from going through this dependent audit. Again, it's not just a financial savings for an employer. Like I said before, the bottom line is you could reinvest the savings into a more competitive benefit plan. It's hard to get people sometimes, in hiring can be a challenge, but having that benefit plan, so many people view benefits as part of their compensation package now, whereas several years ago that was not the case. And it's very studies show that it's absolutely an important part of the benefit plan. We're going to talk real quick about the top 3 dependent verification myths and see if we can debunk those. Number 1, dependent eligibility verifications are too time-consuming and require too many resources. So Cleartrack HR has been in the employee benefits space for 20+ years, and I will be the first to tell you that dependent verifications have been a very, very cumbersome process in the past. It is a lot of HR staff communicating with the employees, a lot of paper floating around. Typically it's mail me something or fax me something. And employees have questions. It's been hard to communicate in the past, and so you don't get the story across up front of why you're doing it and the value. And then on the back end, once you get all the documentation, it's hours upon hours of manually auditing everything. And so it absolutely has been and can be a very laborious process that just can seem, to a certain extent, overwhelming. When we built the Clarify system, we took all of that into account. We said, how can we make this better? And so whether it's the branded templates that are customized to an employer's employee base and talking through that, whether it's English, Spanish, multiple languages, communicating effectively to an entire employee base that we do on the employer's behalf, we think it's very critical, multiple ways to be able to submit documents. We not only accept mail and fax, which is kind of the old school way of doing it, but you can upload documents. You also have a mobile app, so the ability to go into an app store or Google Play and download an app to be able to take pictures. And now all of a sudden people are able to communicate in the way that they're communicating, whether it's through, they're used to using a device for social media, for communicating, for emails and everything else. And so now it just is an extension of what they're doing on a daily basis, and they're able to use that. So it makes the whole process significantly easier. We also offer toll-free numbers and online tutorials. So when they get into the process, even though it's a 3 to 5 minute process to do it, some people might have some technical challenges, and they can call a toll-free number and have someone walk them through the process, or they can actually go online and watch tutorials. Kind of like, I was changing spark plugs in something the other day, and I just Googled it on YouTube, and it's just so amazing how many different things are out there that people have just put out there. Well, we've kind of put all of that process into the system to be able to make within the system to be able to make it easy to walk through and easily understand the process. And then on the back end, what took weeks now takes hours from an auditing standpoint. Everything's completely automated, and so when documents pop up in a matter of minutes, they're audited. And if the front line of auditors reject it, ultimately it goes to a second tier. We might communicate with the HR department to get some verification, but that process takes minutes and hours instead of days and weeks. So we've really sped that process up in the whole thing. Second myth would be that dependent eligibility compliance takes a toll on the employee morale. We've talked a decent amount about kind of communicating and why that's key. And I go back to our education first approach is critical, making sure that whatever language needs an employee has, we do that up front. We make sure that we're communicating in ways that are getting the point across effectively. We make sure that we talk about why why there's a need for this. Like Ben talked about, there's a financial need and a legal reason. And those are things that most employees care about. A lot of times what we have found is that on the front end, sometimes HR departments think that employees are not going to be receptive to that, but studies that we've done show that employees do care. They do want the plans to be in compliance. They do want to have reduced healthcare costs, obviously. And if this is one of the things that it takes to do it, as easy as the process is, it shows that employees do care about that whole process. But I go back to from day one, it's always about that education on the front end, on the back end, and then giving options to employees that are no longer eligible to be on the plan. Give them options to be able to enroll in individual coverage if that's what they want. So communicating is such a big part of it, and it's just and making sure that the employees understand this is not just money that's going to the bottom line for an employer. There's more value to it. So the third and final one is the dependent eligibility verifications are too complicated and confusing for employees. You know, that's a simple one. In the past, absolutely. By the time you have to get your documents and you have to put them in a mailbox and fax, you don't have access to a fax machine, so you have to fax it. Nowadays, it's so simple. You can absolutely go online and get your documents if you don't have them, or if you have them stored at the house, you can pull them out, take a snapshot of it, and upload it to the system. Like we said a few minutes ago, there's 4 different methods. The mobile app or the web app both act the same way. Traditional mailing, we still have a PO box you can mail it to, or you can fax it to us. But ultimately, the mobile app and the web app make this such an easy process for an employee to follow. There's very seldom that we get calls because it's just easy to go through. But if they do have questions, they can absolutely call the toll-free number and go through that. And this slide, the last slide, just kind of next to the last slide shows that the data that we collect. You can see there that the web app and the mobile app, I believe the number, we don't have it up here, but I believe the number is 87% either provide us documentations either through the web app or through the mobile app. So it really is a state-of-the-art process. Everything's automated. Communications going back and forth to the employee are completely automated. And then there's dashboards so employers can see exactly where they are throughout the entire process. And then I believe the last slide is talks a little bit about that. We share the communication method that was most successful. That's one piece of it, but really at the end of the audit, we provide a complete feedback of all the documents, how everything was submitted, the types of documents, the communication pieces that were sent out, and then obviously a listing of the dependents that are not eligible. And then we work with that employer to communicate effectively back to the employee base. Hey, here's the results. Here's what we found. And trying to ultimately make it a positive experience, not only for their employer, but the employee as well. So absolutely, communication is key from the very beginning of the process to the very end. And that's it from me, Jesse.
Thank you, John. John and Ben, thank you both so much for speaking with us today. We have time for a few questions. The first 3 seem to be more focused on dependent audits, so John, I'll ask you to answer those. The first question is, why do we need to do a dependent eligibility audit if our payroll provides verification services?
Yeah, absolutely. That's a great question. And so the thought process goes back to collecting data versus verifying data. So a lot of times, whether it's a payroll or it's a ben admin system, when someone is brought on board, they have dependent birth dates in there, or they have the fact that you've brought that you're married and your spouse is on the plan now, or you have this many children. And I'll tell a real quick story that kind of cracked me up. And we were dealing with we were working with someone. They were talking about their enrollment experience, and there was an employee who had 8 children on the plan. And they were putting them in, and they noticed that the last names were different. So the person actually doing the enrollment kind of questioned it. And the gentleman, had he gone online and plugged that information in, it could have very easily never been caught. But ultimately, that employee was going in, and his wife ran a daycare. And part of what the daycare was, there was 8 children, 2 of them were his, but 6 of the children were not his. They were offering medical insurance through the daycare as an option. And so a lot of times that what happens is a system will collect the data, but it doesn't always verify and authenticate that, yes, that child is my legal child and is eligible to be on the plan. So that kind of goes to answer the question of, it's one thing to have the information about how old a child is or what child is eligible to be on the plan. It's another to actually provide documentation and be able to audit and show how that person is legally eligible to be on the plan.
Okay, thank you, John. And do we need to do a verification audit every single year to prevent new eligibles or new ineligibles from being added back to the plan?
So again, a great question. What we have found mostly, most of our clients will start off with an initial audit. And as you're going through that audit, that's where you're going to see the biggest numbers, obviously. But the system allows you to go on what we call perpetual or ongoing. And so it becomes part of the new hire process. And so when you're bringing that person on and they are going through an enrollment, when they're going through and enrolling for their new hire benefits, it's just as simple as keeping them going through the process and actually auditing them when they're hired. So what that does is it eliminates that need for that large audit on an annual basis. If you are adding dependents, like Ben was talking about, you have the right when life events take place or during open enrollments to add dependents to the plan. The system keeps track of all of the historical information, so you can choose to go back and verify throughout the course during an open enrollment or throughout the course of a year. But also, if you add a new dependent, instead of auditing everyone, you would only audit who that new dependent was. So doing the perpetual throughout the year greatly reduces the need for that audit at the end of the year. But if you wanted to as an organization, you could absolutely go in and just where there were dependents that were added during open enrollment. So it would be a much smaller, not near as heavy lift from an employer standpoint, only doing a smaller percentage of the population.
Thank you. And last question for you, John. Is there a rule of thumb to know if an audit would be right for us? Is it better for a certain size company or type of company?
Any company, any industry can really benefit from this because like Ben was talking about earlier, there's compliance and there's financial. And any company, any industry is going to want to stay, ERISA compliant. And any company could use money or help with reducing their health plans. I don't know of any industry that is singled out saying, hey, I didn't get, an increase in my medical rates this year. So I would say that any company, any industry, obviously, when you're looking at the size of the company, the size could potentially impact the return on investment. And so anytime you get to a larger employer, that could definitely, bump those numbers up. But even we have clients ranging from the smallest that we've ever dealt with is a 76 life group, and the largest we've dealt with to date is just under 25,000 employees. So even though the size makes a difference, if you're spread out, if you don't have maybe the onboarding process is not as controlled as you would like for it to be, and so you want to gain some tighter, pull the reins in on that piece, that could definitely be an identifier to say that there's more value to do a dependent audit. Small companies where everybody, but that's kind of an easy one. But what we have found is that really the industry, size of the company, and are really not. It really is a fit for any type of company or industry. It really depends on how well you currently keep track of who's supposed to be on your plan.
Awesome, thank you, John. And Ben, last question is for you. Are there any compliance issues if we do cover ineligible dependents?
That's a great question as well. Yeah, potentially, right? I mean, first, technically that's a breach of fiduciary duty because the plan has extended benefits to a participant who's not otherwise eligible. So your avenues of risk there are other participants, alleging, hey, this increased the overall cost of the coverage and I'm paying higher premiums now and higher COBRA rates because, this plan's covering people who aren't eligible. The other obviously is the one that we talked about earlier, which is a breach of contract risk with your reinsurance carrier, who could, potentially seek damages, right? If they've determined that you're covering ineligible people, not just for that person, but for other claims they've paid out. So there is potentially legal risk if individuals are extended coverage that aren't otherwise eligible.
Great, thank you, Ben. John and Ben, thanks again for joining us today and speaking for us. And thank you everyone on the line who joined for our webinar today. As a reminder, you'll be receiving a recorded version of this event via email, so be on the lookout for that. And if you're interested in learning more about launching a dependent eligibility verification or just seeing what you could save, please give us a call at 866-581-0496 or visit us online at cleartrackhr.com. Thanks again for joining and have a great afternoon.